Disclaimer: this video is for educational purposes only and is not financial advice. Please do your own research. Is the foundation of global finance finally cracking? For decades, a simple, powerful strategy has quietly fueled markets. It is called the yen carry trade. Hedge funds, large investors, borrow billions of Japanese yen. They do this because Japan's interest rates have been near zero for a very long time. This makes the yen an incredibly cheap source of funding. They then take this borrowed money and invest it in assets that offer higher returns, like United States government bonds, soaring technology stocks. This trade has become a bedrock principle of modern finance, a seemingly endless source of cheap capital that has propped up asset prices around the world. But that era may be coming to a dramatic end. As of February 2026, the Japanese yen is staging a massive comeback. After years of weakness, the currency is suddenly gaining strength. This shift is not a minor adjustment. It is a seismic event that is forcing a frantic unwind of billions of dollars in highly leveraged positions. Traders who bet on a continuously weak yen are now scrambling to cover their losses. The very mechanism that provided stability and liquidity for years is now threatening to unleash chaos. The ripple effects are already being felt across global markets, bonds, stocks, cryptocurrency. This sudden reversal has caught many by surprise. The core assumption of the carry trade was that Japan would remain locked in a low interest rate environment forever. For years, that assumption held true. The Bank of Japan kept its policy rates near zero to stimulate its economy. Meanwhile, the United States Federal Reserve raised rates to fight inflation, creating a wide and profitable gap. But conditions are changing, and they are changing fast. The Bank of Japan is now signaling a new direction, and the consequences could be severe for anyone who is not prepared for this new reality. In this analysis, we will dig deep into the data. We will examine the charts, the policy statements, and the market sentiment to understand what is happening. Is this sudden strength in the yen just a temporary blip, a short-term correction in a long-term trend, or are we witnessing the beginning of a systemic crash? A great unwind that could redefine the flow of capital around the globe for years to come. The stakes are incredibly high. The stability of the financial system could hang in the balance, and every investor needs to understand the forces at play. Stay tuned. To understand the magnitude of this situation, you first need to understand the yen's special role in the global economy. For more than 2 decades, the Japanese yen has been known as the funding currency of the world. Think of it as the global financial system's primary source for a cheap loan. Because the Bank of Japan has held interest rates at or near zero, investors could borrow yen for next to nothing. This made it the perfect tool for financing investments in other parts of the world where returns were much higher. It was a simple and highly profitable strategy that worked for a very long time. This trade, however, relies on 2 critical assumptions holding true. First, interest rates in Japan must remain extremely low. Second, the value of the Japanese yen relative to other currencies must remain stable or continue to weaken. When the yen is weak, investors can pay back their yen-denominated loans with fewer dollars, adding to their profits. For years, both conditions were met, making the carry trade feel like a one-way bet. Billions of dollars were deployed using this strategy, fueling rallies in United States stocks, emerging market bonds. Now that foundation is shaking. As of early February 2026, the USD-JPY exchange rate is hovering around 156. That is down from highs well above 170 just a few months ago. A falling USD-JPY rate means the yen is getting stronger. For a carry trader, a stronger yen is a disaster. The yen strengthening makes their yen loans more expensive to repay in dollar terms. Rapid strength can wipe out profits and trigger massive losses, especially with leverage. This is the scenario beginning to unfold. A rapid rebound forces leveraged investors to close positions. They must sell the assets they bought, sell United States stocks, sell bonds, and rush to buy back yen to repay loans. That rush to buy yen creates a self-reinforcing cycle. The more people buy yen, the stronger it gets. The stronger the yen gets, the more traders are forced to liquidate. This is the unwind analysts' fear, a domino effect across markets. Well, that's the risk. At its core, the yen carry trade is remarkably simple. It operates on the same logic you might use when managing your own finances, just on a much larger scale. Imagine you have the opportunity to take out a loan with an interest rate of nearly 0%. At the same time, you find a savings account or a government bond that guarantees a return of 4 or 5%. The smart move would be to borrow as much as you can at the low rate and invest it in the high return asset. The difference between the interest you earn and the interest you pay is your profit, a concept known as the carry. For institutional investors, the Japanese yen has been that near zero interest loan for decades. They would then immediately convert that borrowed yen into a currency like the United States dollar. With those dollars, they would purchase assets that offered a significantly higher yield. United States Treasury bonds, corporate debt, stocks in high-growth sectors like technology. For the yen carry trade to be successful, two fundamental conditions must be met. These are the twin pillars that support the entire structure. The first, and most obvious, is the interest rate differential. There must be a significant and stable gap between Japan's low borrowing costs and the higher returns available elsewhere. For years, this was a given. The second pillar, which is equally crucial but often more volatile, is the currency exchange rate. The trade is only profitable if the value of the Japanese yen remains stable or, ideally, weakens. If the yen becomes more valuable, it will take more of their dollar-denominated investment returns to acquire the yen needed to settle the debt. It created a positive feedback loop. The carry trade itself contributed to a weaker yen, which in turn made the carry trade even more profitable. However, this reliance on the exchange rate introduces a significant and often unpredictable risk. This is the carry trade's Achilles heel. That's the core danger. To make these modest returns spectacular, traders use leverage. Leverage means using borrowed money to increase investment size. In the yen carry trade, investors borrow far more yen than their capital, sometimes amplifying positions by 10 times, 20 times, or even 50 times. That magnification cuts both ways. Leverage can turn a 4% return into 40%. But leverage is a double-edged sword. It magnifies losses with terrifying speed. With capital only a small fraction of the position, a small adverse move can wipe out the investment. In the yen carry trade, the danger is the currency rate. That triggers a margin call. Forced selling to buy back yen can trigger a cascade. As leveraged players liquidate, they push the yen higher, which triggers more margin calls and more liquidations. This unwind scenario keeps central bankers awake at night. Small currency moves, amplified by extreme leverage, can lead to market panic and systemic instability. The first piece of hard evidence comes from the bond markets. Now in early 2026, that divergence is rapidly shrinking. The engine is losing power. Recent data shows Japan's 10-year government bond yield is now approaching 1.55%. That would have been unthinkable a few years ago. It's a direct result of the BOJ's policy shift. In a landmark decision, the BOJ raised its benchmark interest rate to 0.75%, the highest in 3 decades. Furthermore, the bank has signaled that more hikes are coming. At the same time, the story in the United States is the complete opposite. The Federal Reserve has paused its aggressive rate hiking cycle. The market is now pricing in potential rate cuts later in 2026. The carry or profit margin is being squeezed from both sides. The cost of borrowing in yen is rising. The return from investing in U.S. bonds is falling. This compression fundamentally alters the economics of the trade. The risk-reward calculation for the yen carry trade has been fundamentally and perhaps permanently altered by this new era of policy convergence. A second crucial dataset reveals a market on edge: investor sentiment. For months, the VIX was unusually calm, hovering around 14. That calm signaled investor complacency. After the BOJ's hawkish moves, that complacency evaporated. The VIX shows a clear, sudden spike, closing above 17. Not outright panic, but a significant, telling move. Institutional investors started buying protection. They're purchasing options that pay out if volatility rises. Portfolio insurance. Currency options markets show similar patterns, especially USD JPY. Traders are paying higher premiums to hedge big yen moves. Markets are pricing higher volatility for Q1 2026. The message is clear. The calm is over. Big investors preparing for a storm. They're, battening down the hatches, fearing an orderly unwind could turn into a chaotic exit if the yen keeps rising. A critical question: just how big is this trade? Understanding the total amount of money involved is crucial for gauging the fallout. Getting a precise figure is notoriously difficult. Trades run across countless banks and hedge funds, and through complex derivatives that aren't centrally reported. Estimates vary widely, leaving a murky picture. On the low end, recent analyses citing BIS data suggest the speculative yen carry trade is smaller than feared, pegging it at around $261 billion. Proponents say the trade has been quietly unwinding for months, with no year-over-year growth last quarter. They argue the market is adjusting in an orderly fashion, but other sources paint a more concerning picture. Analysts at major banks like Morgan Stanley offer much larger estimates, suggesting up to $500 billion could still be active. A rapid unwind forcing liquidation of $500 billion would send shockwaves across markets. U.S. stocks, European bonds. The gap between $261 billion and $500 billion isn't academic. It could mean the difference between a manageable event and a systemic crisis. The speculative carry trade by hedge funds is only one part of the story. There is a second, much larger flow of capital at risk of reversing: the investments of Japan's institutional giants. For decades, Japanese pension funds and life insurance companies, faced with near-zero returns at home, poured trillions of yen into foreign bond markets. Now that incentive is changing. As the Bank of Japan raises rates, JGBs are finally starting to offer a meaningful return. For a Japanese pension fund, investing at home eliminates currency risk. As Japanese investors sell foreign bond holdings to bring capital home, it puts upward pressure on yields elsewhere. After the BOJ rate hike, Germany's 30-year bond yield surged to its highest level since 2011. This is how the BOJ's decision in Tokyo affects a mortgage in Ohio or a car loan in California. The era of cheap global funding, underwritten by Japan, is drawing to a close. Given all these conflicting forces, where is the dollar-yen exchange rate headed? Modeling different scenarios based on central bank policies lets us outline a range of possibilities for late 2026. Orderly convergence. BOJ proceeds with well-telegraphed rate hikes. The Fed enacts a few modest rate cuts. USD/JPY gradually declines to roughly 144 to 148. Yen strengthens but no chaotic unwind. BOJ shock. Underlying inflation in Japan proves more persistent, forcing BOJ hikes faster and higher. That could trigger a panic among carry traders. USD/JPY could break below 135, causing widespread losses for leveraged players. Dovish Fed pivot. U.S. economy weakens, forcing aggressive Fed cuts. Even with a moderately hawkish BOJ, the yield spread shrinks and the yen strengthens. USD/JPY likely moves into the 135 to 140 range. Key takeaway: the path of least resistance for the yen is up. But risks are skewed toward a stronger yen and a more painful unwind for the carry trade, challenging the very stability of the global financial architecture. So, what does an unwind actually look like in practice? It begins with a trigger. It could be the Bank of Japan hiking interest rates faster than the market expects. Or it could be whispers of a joint intervention. As the yen rises, the first wave of margin calls goes out. The most highly leveraged traders, those who borrowed 20 times their own capital, are hit first. And those using 50 times leverage get crushed next. Many cannot meet the margin calls. They are forced to liquidate. They use the proceeds to buy back yen to close out their loans. This forced selling creates a vicious cycle. Panic can spread from currency markets to equity markets to bond markets. We saw a small preview of this when a recent BOJ decision caused Bitcoin to drop nearly 3% in just 2 hours. A simple 5% strengthening of the yen might seem manageable. But for a trader using 20-to-1 leverage, that 5% move becomes a 100% loss, wiping out their entire initial capital. It is a fire that feeds on itself, and once it starts, it can be very difficult to control, threatening to burn through markets far beyond Japan. The fallout from a disorderly unwind would not be contained to just a few hedge funds. The effects would spread like a contagion through the interconnected channels of the global financial system. As Japanese institutions and carry traders sell U.S. bond holdings, it would flood the market with supply. The pain would also be felt acutely in the stock market, particularly in high-growth sectors like U.S. technology. Consider the global pension funds and insurance companies that mimicked the carry trade. A sudden yen surge would create massive liabilities for them, potentially impairing their ability to meet obligations to retirees. The ultimate fear is a full-blown liquidity crisis. The demand to buy yen spikes while the willingness to sell it evaporates. This can cause credit markets to freeze up. The plumbing of the financial system gets clogged. It is not just about traders losing money. It is about a cascading failure that starts in a niche currency trade and metastasizes into a broader crisis that affects the real economy. While a chaotic unwind creates many losers, a strengthening yen also produces a new set of winners. The most obvious beneficiaries would be within Japan itself. A stronger yen would reverse this, providing immediate relief to Japanese households and businesses by lowering the cost of essential goods. This could boost domestic consumption. Within financial markets, certain assets would also perform well. Japanese equities, particularly those focused on the domestic economy, could see significant inflows. The local stock market, the Nikkei, would be a prime destination. Conversely, the list of potential losers is long. The core theme is that assets whose valuations were inflated by an abundance of cheap, yen-funded capital will face the strongest headwinds as that capital withdraws. The tide is going out, and we will soon see who has been swimming without a bathing suit. For the global investor, this new reality demands a fundamental reassessment of portfolio construction. The decades-long strategy of simply riding the wave of yen-funded liquidity is over. As we piece together the evidence, a clear picture emerges. The decades-long party fueled by the yen carry trade might not be over, but the lights are flickering. Those pillars are eroding. Critical signposts to watch, starting now. USD JPY exchange rate. Breaks below could accelerate an unwind. US-Japan 10-year yield spread. Market fear gauges. Central bank language. Panic or opportunity? The answer is nuanced. Not a time for blind risk-taking. If you're exposed to yen-funded assets, reassess. Set stop losses. Explore currency hedges. For strategic investors, repatriation could create buying opportunities. Final verdict: the yen carry trade is under significant pressure. The risk of a disorderly unwind is real and rising. Prudence, preparation, and a keen eye on the data will be the keys to navigating the volatile waters ahead.